investors are really anxious, and Nvidia has not performed well the last few times it's reported. But the story arc there remains that that is one of the most important companies in the world in the middle of the biggest structural change in the world economy. So I think Nvidia still is a great story.
Tom Lee starts by pointing to Nvidia, which many consider the beating heart of the AI revolution. Investors are anxious. Nvidia hasn't performed well around its last few earnings reports, and that has sparked questions. But Lee emphasizes that Nvidia's story remains intact. This isn't just another stock. It's a company at the center of one of the biggest structural changes in the world economy. Even if Nvidia disappoints in the short term, it doesn't change the long-term thesis. That thesis is that AI is not a fad, but a generational shift that will transform productivity, business models, and capital allocation across industries.
Wouldn't change our thesis if the stock reacted poorly.
You feel like there's become a little more AI anxiety, as we wrote at the top? You know, from Sam Altman at OpenAI saying that, investors are a little overeager about AI. Meta's reorganized again. They've stopped their hiring. There was another report today that suggested some of these Gen AI models are failing. You think there's anxiety in this market about this trade?
Well, I think everyone's trying to get situational awareness. Like, is this inning 1 or 2 or late innings? Because we know there's been a lot of value creation and a lot of capital that's flowed in. And we know that Silicon Valley has seen a boom of companies with $100 million annual run rates, like in record time around AI. And a lot of people want to ring the bell at the top. But to me, it still feels really early because there's such a limited number of stocks that public investors can buy that represent a direct play on AI.
I know, but that could lead to bubble-like activity, right? When your pool of investable opportunities remains so small, all of this money rushes to a select few.
Yes.
And then they have to live up to all of that hype and give a great return on these hundreds of billions of dollars that are being invested. That's not a risk?
Well, it is a risk. I guess that's really the next stage of what we have to see is how does the market accept now adding to the roster of direct AI plays, beyond just Figment. And I think, if we look at the next 12 months, there'll be a bevy of IPOs, some really big companies that are later stage. But if they're bought and they produce good growth and their stocks perform well, I would still say that still means we're early innings.
That's still your favorite trade?
I think it's the most important trade, yeah.
I know it's the most important. I feel like that's legit. But is it?
I think there's a bigger upside in the owning financials right now. Because financials are benefiting from AI.
Okay.
So they're the second order beneficiaries. Plus they're getting the green light to build on the blockchain, which could really make JP Morgan and Goldman's business models so much more profitable and change their multiples, expand them. So I think, yes, I'm still bullish on AI, but I actually think the financials are really one of the legs that drive us the next 12 to 24 months.
Oh, interesting. No matter what the Fed does from here, does the rate picture matter for the bank stocks?
It does, because it provides the liquidity to sort of liquefy housing and corporate lending and bring spreads down. But I think the financial sector has produced visible earnings growth for a long time through these cycles, and they are trading like cyclical stocks. JP Morgan and Goldman should maybe have tech multiples. And so I think there's upside for financials.
They're aside from when the broadening started to happen on the idea of rate cuts, those were the type of stocks already that were leading this market along with the mega caps. This is a large cap stock rally,
yes.
Right? Industrials,
correct.
The biggest names out of the industrials, the biggest names out of the financials, the biggest names in tech were leading the way.
Yes.
Do you think that continues?
Yes, and because, at the end of the day, when you look at GDP, for every unit of economic activity, there's one unit of financial. So financials are half the economy, but they're not half the index. Now, I'm not saying they're going to get to half the index, but they really should re-rate. I think even this quarter, right, the numbers from JP Morgan, Goldman, and the financials, and look at the bullish IPO, these are all good signs to me that you want to be overweight financial.
This suggests we are not in a narrow, fragile rally, but a more durable expansion. When companies like JP Morgan and Goldman are performing well at the same time as Nvidia and Microsoft, it signals that the gains are more evenly distributed. That makes the rally healthier and potentially longer lasting.
Most people in the US have multiple brokerage accounts, right? I have the pleasure of having multiple brokerage accounts, so I can compare them. Even in the US, your brokerage account differs, right? In one brokerage account, I've got 24/5 trading. The other one, I don't. The margin I can get in one brokerage account, I can actually take off the platform, and the other one, I can't. You can just use it to invest more. And in fact, I've got two brokerage accounts. So all the time, my assets are split in two, because depending on the fees, I may select one versus the other. And then my crypto assets are in another different account, right? So now I have three different investment accounts. So even in the US, the landscape is very fragmented. Brokerage looks different depending on the account that you have. But once you tokenize these things in a similar form like you can do with stablecoins, all of a sudden you can transfer them between your various platforms. If I want to take out a margin loan, I can actually shop around in the various DeFi ecosystems, depending on what I want. I can do that 24/7, God forbid, like normal TradFi rails. They're often, during normal market hours, if you're lucky, 24/5. So there's, even in the US context, tokenizing your stocks really opens up the landscape of what a brokerage account can be, what you can do with it. It's kind of also, again, similar to what a stablecoin did for a bank account. I'd say most people in the US, at least the crypto natives and on-chain natives, appreciate that a stablecoin is much better than the cash you can have in your bank account for a wide variety of reasons. But even with a bank account, at least I could transfer my cash very easily from one bank account to the next. In a brokerage account with stocks, I mean, you can, but it's pretty difficult. So the leap that we can take by tokenizing stocks, even for US investors, to just enable interoperability between brokerage accounts, you being able to shop around margin, it's pretty meaningful. When you tokenize stocks, when you want to buy stocks on chain, the most important thing is when you go to your Robinhood account and you see Tesla trading at 420, when you buy it on chain, you want to be able to buy it at 420. But in some of these implementations, instead of being at 420, it may be sometimes it's at 400, which would be great for you, but sometimes it's at 450, which is less great for you. And even if you then want to easily, swap these back into stable coins, that liquidity may not really be there. And the reason that this is happening is because there's a disconnect between the trading in TradFi on the NASDAQ, the New York Stock Exchange, and the like, where all of the liquidity for these assets is. The 420 price really is set on these centralized exchanges like NASDAQ and the like, because that's where the trading happens. But then you've got these on-chain assets that in some models out there rely on different liquidity pools, like think of DEX pools that people have deposited these things in that people can trade in and out of. There's no connection between the two. And so as a result, the price that happens on-chain that is available in these DEX pools and the like can drift up. If there's no connection to easily arb it down, that's when you get the depegging. It's kind of the same thing that we saw with stablecoins. You need 24/5 to 24/7, ideally minting and burning, like connectivity between the TradFi rails and the on-chain rails to make sure that these prices stay in equilibrium.
Ian Bode's perspective highlights both the promise and the challenges of tokenized finance. On one hand, tokenization could bring us a world where stocks, bonds, and even complex financial products move across blockchains as easily as stablecoins do today. On the other hand, liquidity fragmentation, depegging, and regulatory uncertainty remain major hurdles. But make no mistake, this transition is already underway. Just as stablecoins quietly transform the way we think about cash, tokenized stocks could quietly transform the way we think about brokerage accounts, equity ownership, and global investing.